For someone listening, they're like, hey, you just said about the bottom of the market and you kind of saw that last year. Are you able to pick the bottom of the market in hindsight, or are you at that time going, I think we're hitting the bottom?
We identified it as bottom of the market. Yield, rental, vacancy rates were quite low, and that's what gave me the confidence. We were seeing yields in Melbourne back in COVID time. We were sitting around 2.5% to 3%, and middle of last year you could get anywhere from 4 to 4.5%.
Wow.
Metro Melbourne, which is pretty good.
How do you then start to go, this is how different markets are moving in Melbourne?
Have a look at the infrastructure pipeline. You generally see a lot more activity.
How's the market treated you in 2025?
We're getting them probably 50 to 60K. I'd say like 5 to 6% less than what they quoted pre-market. The psychology of the market is actually quite interesting.
Yeah, tell me more about this. G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. You guys have been listening for some time. You know that I like to go far and wide to get some really good guests, mix things up a little bit more, really find what I call best in breed. Every weekend, you'll probably find me down at a cafe on a Saturday with my two crazy girls, me trying to read the Australian Financial Review while us having a coffee. And I'm always reading the articles because I think, keeping yourself sharp mentally, but also, knowing what's going on from a news and current affairs perspective really puts us in the driver's seat as well. One of the names I did come across was Abdullah Nouh from Mecca Property Group. Featured about a couple. They're actually down our way towards Wollongong. They're not our clients by any means, but how they transition out of resi into commercial going into retirement. That pretty much sparked my interest going, yeah, tell me more about this, Abdullah. And so that's something that we're going to cover in our chat today. But also as a buyer's agent, very much want to get your view on what's going on the ground, what you're seeing with your clients as well, and get a feel for the market as we round out 2025. So Abdullah, welcome on, mate. How you doing?
Thanks, and I appreciate you for having me on here. I'm doing well, thank you.
Beautiful.
Not bad.
Excellent. Not bad. We were talking before, mate. You got your hands full. You got a business. You got 4 kids, 2 boys, 2 girls, mate. So if you think everything works busy, you go home, you go start your other full-time job as well, mate. Tell us about how's the market treated you in 2025, and as a buyer's agent, what have you typically seen throughout the year as well?
Yeah, 2025 has been a really interesting year. I think we're seeing improved sentiment in locations that have been struggling. So Melbourne is one of them. I think Melbourne,
based, right?
Yeah, it's where I'm based. Yeah. And like over the last 4.5 years, we've been buying interstate just because we've been seeing better value in the likes of Queensland and Adelaide and Perth. And I felt, and like being on the ground in Melbourne and just obviously, talking to a lot of agents, we started to feel that the bottom of the market was probably August, September last year. And we started to then talk to our clients, that, have got some equity about, I think it's a good time to actually get in. The market's quite down. And I actually, the psychology of the market is actually quite interesting because last year we found, off-market deals, vendors had a higher expectation of what their property was worth compared to what the market will give. So we were actually buying a lot of property either at auction or post-auction.
Yeah, nice.
And we were getting them probably 50 to 60K, I'd say like 5 to 6% less than what they quoted pre-auction and pre-market. And yeah, it was just it was at a time where, people were, there was a lot of sort of negative sentiment in the media. But yeah, look, we're seeing, this 12 months on, we're seeing, off-market opportunities are actually a lot more value than on market. We're seeing a bit more competition. The 5% deposit scheme is really, spruiked up demand from home buyers. But yeah, no, it's been really good, interesting year. We're seeing a resurgence back in Perth. We're seeing, Darwin has probably been the X factor sort of city, where we're seeing some growth rates, some consistent growth rates there.
Beautiful.
Yeah.
For someone listening, they're like, hey, you just said about the bottom of the market and you kind of saw that last year. What are the markers? Because are you able to pick the bottom of the market in hindsight, or are you at that time going, I think we're hitting the bottom? Because there's 2 ways to look at it, going backwards, going, that was the bottom and things have rebounded, or at the time going, I think we're coming out of this at that stage. So do you pick the bottom at that time, or have you identified that as the bottom of the market?
We identified it as bottom of the market, and one of the main factors we were looking at was the yield, rental, vacancy rates were quite low, and we were seeing yields, in Melbourne back in COVID time, we were sitting around 2.5% to 3%, and middle of last year you could get, anywhere from 4 to 4.5%.
Wow.
Metro Melbourne, which is pretty good. So that's what gave me the confidence that, and obviously we're seeing what's happening around the country. we were looking at Brisbane and Melbourne and going, this property is like almost doubled in the last 4 years, and this one hasn't moved, and we're seeing the same yield rate, right? Although you're paying, although the land tax threshold has changed, if you incur all the actual holding costs, Melbourne actually has a lower insurance rate. It has a lower council rate, water rate. Property management is like 2%, 2 to 3% lower than Queensland. So when you incur all these like differences in fixed holding costs, you can actually take on that extra land tax payment. It doesn't really. You look at the net sort of holding costs. You're sort of sitting somewhere between 9.5 to 10K for a Melbourne and Queensland property, and that's what sort of triggered triggered the way we were looking at Melbourne last year.
Awesome, thanks very much.
Yeah. Sorry?
There's someone coming in. I mean, Melbourne, like any capital city, there's markets within markets. There's your regional type or bigger corridors as well. So when you look at the market in Melbourne as a whole, how are you then separating? Say, I don't know. I'm just going to make up some names here. Your Geelong, your Ballarats, your Bendigos, your Sheppartons. Like, how do you then start to go, hey mate, those are lag markets, for example, versus hey, draw a ring around, say, the Melbourne CBD and go, these are the ones that are going or moving quicker. How does someone that doesn't have your skill set or doesn't have your years of experience or knowledge go, this is how different markets are moving in Melbourne?
Yeah, that's a really good question. Look, I would say, if you gave me a property, if I had a 700K budget, would I go buy in Bendigo or Geelong versus Melbourne? I'd probably stick with Melbourne. But I think so supply risk is what if you're buying in an area that has a high supply pipeline, like call it like the western part of Melbourne, and you can include Geelong in that, does have a very high supply pipeline with just new builds, and we find that sort of dampens sort of your growth rates. And Geelong, if you look at Ballarat as well, Ballarat, during post-COVID had a very high supply pipeline. We saw listing numbers go up to about 1,200 properties for sale at any given month, whereas before during COVID it was sitting somewhere between 300 to 400 listings. So I think it's just making sure if you're trying to decipher which area to buy in, just maybe look at areas that are supply tight, right? So why I like, if I look at Melbourne as a market, I would say the inner north and, north up to about probably a few suburbs into the city of Hume, Whittlesea is not bad, like up to probably Lalor, Thomastown, and then the northeast and east and southeast, they're all relatively supply tight, and you're almost buying properties there at land value. Like, there is a ratio we call land to asset ratio. So if you're buying a property for 800,000 and say the land value is worth, call it 650,000, then a lot of the investment's actually in the land, and the house is almost free, right? And a lot of those properties typically are quite older, so you'd have to put some money into just refurbing it or make sure it's structurally sound so they can last you for another 10 or 15 years.
Yep.
But that's where we're probably seeing the most value. Newer areas we see it's probably a 50% land to asset ratio, where you're paying 50% for the land and 50% for the build, and it takes a bit more time for you to see that growth. But yeah, Bendigo, and I'd say a good way to also decipher is have a look at the infrastructure pipeline. I think the more infrastructure government spending or private, the more private investment and infrastructure investments being put in the area, you generally see a lot more activity in the economy, and you see job opportunities, you see people moving there. So they're essentially the drivers that you look for.
Okay, awesome.
Yeah.
Mate, one of the questions I've got here that we get frequently is, should I buy two properties at 500K? I mean, 500 is an arbitrary number, or one at $1 million. So you could go, do I buy two at 600 or one at 1.2, for example? Now, I'm going to preempt and say that the right answer is, well, depends on your strategy as a first step, which I'm sure you'll do. But let's say someone is starting out. They've got their own home, for example. So we'll give this some context. Double income household, so mum and dad work, let's say 2 kids, because that's the average. Decent incomes. and there's equity in the home to then pull out. Yeah. Someone says, look, I want to get started on my investment property journey. Do we go two lower end properties or do we go one higher end? What would be your initial thoughts there?
Right now, I say quality is better than quantity right now.
Okay.
If it was 3 years ago, these other smaller capital cities were just very much affordable, and they're getting some really good yields, and you can really see the value, the opportunity, and the uplift. But the two 500k properties in Australia right now, where are you going? You're probably going to, a very remote regional area. I would stick to, quality over quantity. I'd probably buy an asset where you could create value over its life cycle. So, that old house on a 600 plus square meter block where the house is positioned right at the front, you've got really good side access. The house is original. You can improve it, where you could maybe renovate the interior to increase the value. You can add a granny flat to improve cash flow, or you can just, subdivide, sell the back block, or subdivide, build another house, and you've got two assets. I find that is better because when you go quantity, where you can get caught out is you've got, two kitchens, 4 bathrooms, 2 different tenants, and residential assets, they do cost a lot to hold, right? There's a lot of like moving parts, and there's a lot of like, tenants, generally speaking, they're not going to look after a home like an owner occupier. So I'd play the long game.
Yeah, nice. Thanks very much. And I guess that higher end of town, circa $1 million, for example, do you find the yields change a little bit? Obviously, slightly premium price point. Is that a softening in the rent compared to those lower end of the markets as well?
Yeah, like the yields take a bit of a hit when you go into sort of 800 plus, like 800 to 1.2. But you could also increase the yields just by adding a granny flat. And we've done it. We've done a few projects this year for clients in Melbourne where we've bought properties probably 11 k's north of the city, 11 to 12 k's north of the city, a suburb called Hatfield and Faulkner.
Okay.
And we built 3 granny flats for each property. Yeah. Not through us, but through a third party.
Yeah.
And we got those yields up to about 5.6%. Right, on an 850k purchase across the board. And one was 760, other 850, and one was 785. And the value uplift, they got a value uplift. It wasn't those container homes that you buy because there's not much, they're not considered actual granny flats. But it was a proper, went through a building permit, built a 60 square nice granny flat, got different power, different water meter. And basically segregated both houses. So you've got 2 segregated homes and both are renting quite well. So, and there's a market for it, especially in the established areas.
What about if you go to sell it? Are you particularly selling to an investor or like a multi-gen type family? Like, take me through that. Because if I'm buying, say, my family home, I don't know, I wouldn't have much use personally for a granny flat, perhaps. But what happens around the resaleability of these properties?
Yeah, that's a great question. We have purchased sites that have approved granny flats on there already in Melbourne as well. And what we found is when we go to auction or when it's taken to market, there actually isn't a lot of interest on these assets because your families were looking at that going, well, why do I need a granny flat in the back, right? So your pool of people that would be interested in that asset class is probably going to be a family that needs, that has, their parents that want to live in the back, or it's going to be an investor, right? So typically what we do is when we build a strategy, we go, this is a 10-year hold, 10 to 15-year hold. Let's build you a granny flat to get the yield up so you're not too out of pocket. The granny flat's going to probably pay itself off. They churn around 22 to 25k a year, right? So over 5 years, 125k, over 6 years, it's paid for itself. Then you get the depreciation benefits after that. But let's say you hold it for 12 to 15 years. What you can actually do after that is you can actually demolish the whole thing because the granny flat doesn't know you anything. It's made you money. Demolish it, and then you can create further value by building a duplex or a multi-town house site. So they're not assets where you would come to sell it to make a profit. they're more so to help you hold it over its longevity, over its 10 to 15-year period.
Thanks very much. Always want to ask that question around what's the strategy with, put the grannies on there, for example. I think probably at the start of my career in broking, granny flats, particularly when we're doing stuff in Sydney, you could knock it up for 100, 110K. Now you almost see that well over the 150, sometimes even 200K, if they're slightly better quality of finishes, for example. So that is definitely, obviously, every building cost has increased, kind of post-COVID as well. But I just feel like they've shot up. So those yields get a little bit compressed around what you typically get on a granny flat as well, right?
Yeah. Look, we it's not a strategy that every client would follow, because when you build a 15-year plan, right? It's very important to understand, like, where do you want to be, in 15 years or in 20 years time, and depending on where you are in your journey, right? Whether you're sort of in mid-30s with a good business and good income, you probably have that longevity where you can buy a site and not put a granny flat on, but your second site could be a commercial investment that offsets the losses of your initial, negatively geared property, right?
Yeah.
So you don't, like, granny flats is not the solution for everyone. I always, I think my mindset around granny flats is it has to be very particular around the type of investor we're dealing with and how, and then where they want to park it, like what, that they would have to have the funds to do it. And we actually have helped an investor buy it with a granny flat revalue, get the money back out, buy your second one. This sometimes can help fast track that and keep that. It's all about keep managing that yield. But some investors, we can go house within commercial, maybe another residential after that. I think having a hybrid portfolio is important.
Okay. Yeah. So you've just kind of touched into the notion of adding commercial to a portfolio. Again, we talk about strategy. So this is not the strategy for everyone. It's never a one-size-fits-all model, for example. And even back to that question around 2 500s versus $1 million. Some people just maybe don't have the budget to go to $1 million, for example, and they've got to play within their budget. So please, when we're talking about these questions, very much got to be on a strategy, case-by-case basis. What are you wanting to do? Back to your point, Abdullah, which was, what are you looking for? What time horizon are you looking to get these results in as well? So I've got some clients that 2-3 years, they want to be in and out, whereas others are like long-term buy and holds. I never want to sell or my kids to have these properties, for example. So it's a very different mentality. Investor A to investor B, very different buyer's agent that you are compared to another BA, for example. So when you're picking your team, when you're picking your strategy, just know you've got to start to get these things to align as opposed to kind of square peg round hole, which again we've touched on a lot in a lot of our episodes as well. So I just want to touch on that whole notion of adding in commercial. What type of investor are you seeing that moves into commercial, and what does then that commercial asset look like?
Amazing. Okay, so the type of investor that gets commercial that we're working with are generally business owners that are looking to transition away from their business income, right? So they're potentially looking to sell down their business in 10 years' time. We recently helped it wasn't recent, but this is a 3-year case study that we've had where we had a dentist that joined us, ran his own dental practice, loved his job but didn't like managing the dental practice. And he had a plan. The plan was to replace his income about 20K a month. At 1.2 in cash, no debt across his personal home and his business because he owned the property as well. And his idea was, let's just buy, apartments or units. Let's just get, 10 of them, have a good yield, and, just build up that cash flow. Anyway, I said to him, look, I probably wouldn't do that, but let's build a strategy. So we ended up buying him a $3.5 million commercial industrial site in Gold Coast just 3 years ago in a suburb called Yatala.
Yeah, nice.
And he had we negotiated a 17-year lease because it's a lease back. So we negotiated a 7-year lease with 2 5-year options, 4% increases per annum. Anyway, it ended up being a 5.85% net yield, which reflected to about 18K a month. Anyway, 3 years on, he sold down his business for 2.8. The loan against that commercial is 2.7. He's paid out that commercial loan. He's living off, almost 19K a month in income, right? So he sold his business and the site for 2.8. So they're probably I would say, business owners are the ones that, I think looking to transition, when they're looking to transition away from that sort of, high income. I think the other one is we have some investors like retirees, or investors that have cash, don't have the serviceability to go buy residential, don't want residential, but they had to have anywhere from $500,000 to $1 million in cash. And we would look at getting them a commercial industrial property through a lease stock loan. Right? So, and we did one recently. Couple were, basically gifted $1 million from their parents. Parents sold up and overseas, gifted them $1 million. They came to me and said, "Look, we can just go buy a house in Point Cook, cash. What do you suggest we do?" When we went through the strategy, it was like income was very important to them. So we actually ended up buying a block of shops, like 5, just one whole building, but it had 5 different shops in it, retail shops. In Hobart, we paid 2.5, and I think the lease on it was about 160 net per annum. So, and they got that on the lease stock loan. So, so that's, I find that, if your priority is income and you want to see growth, because with commercial, as you know, like it's all about the cap rate, and you do get more linear. You can forecast your growth a lot better than residential. It's more based on income. Commercial could be that avenue for you, and the different types I would say is, industrial is probably the lowest risk profile. It's a multi-use asset class. Specialized use is more like retail and medical, where it's probably a little bit more riskier, and banks will offer lower LVRs for them. You'd know, obviously, you're the broker of it.
Yeah, and I think what you've mentioned there is 2 very distinct types of clients. For example, self-employed definitely suits commercial. For example, as they're buying their own premises through a super fund. They want to de-risk their business, for example. That's definitely one that we see. That's a great similarity there as well. And then I think the other one is, hey, I don't want to have quantity of investment properties like residential. I want to have one particular site. It makes it a lot easier to manage, but I'm still looking for a strong yield and strong return. Great. Commercial becomes a very strong vehicle maybe to exit residential once you've kind of reached the point. I think what happens here is residential gives you the ability to piggyback, like, release equity, go again. And that's the beauty of, like, that's a very repeatable model. A scalable model happens in residential. What generally happens to a point is we see residential investors start to hit like a bit of a ceiling, not only borrowing capacity, but just bandwidth to go, man, that's like now the portfolio is getting quite sizable. Be careful what you wish for, because we've now got it. And now what we want to do is just minimize the administration that comes with running a portfolio as well.
Right. Yeah.
And the way to then, transition and move sideways almost is to move into commercial. One site, like you said, 4 or 5 leases on it, for example, it's like bang, just one spot. Yes, there's a bit of concentration risk on that as well, compared to being, 10 properties across the country. But if you've bought well, you've bought smart, we've generally seen it done well. You're in a cracking location, great tenants that are, it's a blue chip type site that's never going to go out of fashion. And it's like, hey, high street retail struggles. It's like, well, hang on, we've eliminated that risk by buying a good quality area, high demand, low vacancy as well. Yeah.
Yeah. Another one, Aaron, too, is like retirees on the AF article that you read. So we had a client who basically got to, the selling down their business and early retirement. They sold out their investment portfolio. So look, every investor goes through, I think anyway, 3 stages of their sort of journey. And they go through an acquisition phase where they try and accumulate as many as they can. And they start off with residential, as you said, to try and piggyback and rinse and repeat. And then they sort of generally hit a ceiling at some point. And then they optimization phase. So they look at, each residential property, what can I do to optimize each of these assets? Can I renovate to increase the value and extract more equity, or sell down? Can I add a secondary dwelling in the back to create further equity? And the last phase is consolidation. And consolidation is where you actually start to consolidate your debt. Because when you get to retirement, you're not thinking about, hey man, I'm at $10 million, I want to get to 50 million by the age of 75. You're just thinking about lifestyle. You want income, right?
It's the rare person that just wants to go on an absolute tear and build a $50 million portfolio. At that stage, man, they've got more money than they can probably spend. And 10, 12 million. they'll take care of the kids and like, I don't need to be greedy. I know I could probably keep doing it, but they don't, bandwidth wise, they just don't want the headache.
Correct.
Yeah.
Correct. And we helped Peter and Leslie, right? And they were great clients of mine. But we essentially they had $2.5 million in cash. Their accountant was brilliant, and their broker was too as well. And we ended up getting them. They got a lease stock loan to go up to 3.25 at a 65% LVR for a multi-use asset, which is like an industrial use. Specialized use, the lender was going to go down to 50. And the income had to cover up to 1.5 times the interest, right? So we're working off a 6.1% net yield. Now, it took me 4 months to find this asset, not because it's hard to find commercial, it's just hard to find good quality commercial, right? And I said to my clients at the start, you're probably going to hear from me 3 times because it's very hard to find good assets, right? Anyway, on the 4th time, we found this site. It was an acre, 12 k's north of Perth CBD, Malaga. I'm not sure if you know Malaga, but it's a great little industrial, fully established pocket. It was one of the first properties built on this street. It's on an acre block of land, and the business has been there for 40 years. And we essentially got it on a lease stock loan. On a lease back. So they sold down the property, and we essentially agreed to a lease. They signed the lease, and then we took over that lease. And it was a 7.1% net. And the clients, based on a 65% LVR, they still had 1.2 sitting in their offset account, and they were making about 150K passive income per annum. That's so if it's very, very important, I say this also to my clients, like to build, that wealth mindset is very, very important. To know what your goals are is so important, and you don't have to like overcomplicate it. And you have to be like you have to have that awareness as to where you are, like, what are your limitations as an investor? Because if you understand your limitations and you know what your goals are, then building the strategy is actually quite easy.
Yeah. Thanks, Abdullah. Yeah. Okay, cool. Yeah, I mean, when you talk about strategy, I mean, most would fit into maybe these 3 categories. 1 of 3: capital growth, cash flow, or exiting with a profit, which would be like a development or a strategic, split block, for example. So if we take a capital growth, the way that you come in and add value, probably a really good renovation, for example, do something to the property that's going to give it a quick uplift to try and strip some equity. The next one, cash flow, like you said, you could do a granny flat, for example, go in there and try and bolster your yield. Or the last one is just trying to exit with a profit. So buy, develop. So you maybe do a duplex, maybe do something strategic on that property, subdivide the property. Which one have you seen, or give some examples of what you've seen done very well? I mean, we've touched on the granny flats, for example, but how does someone come in and do a really good strategic reno that's going to give an instant equity uplift, do you think?
Yeah, that's a great one. What I've seen work really, really well is, number one, buying in the right market. So you could attempt to do a renovation uplift, but if the market is going through a recorrection, you're probably not going to see that return come on the other side.
Okay.
So if you choose your market, number one, buy in a market that's going through that growth cycle. And generally speaking, if you buy a property that's quite weathered, soon you can get it for a better price. And then when you add the value, all of a sudden it's worth more, right? Because most buyers want a turnkey asset, right? So that's number one. Number two, I would look at, where I've seen done quite well is when you buy a 3-1 and turn it, say, into a 3-2 or 4-2.
Beautiful.
It works really well when the floor plan is actually big enough. Like, there's no point doing a 3-1 into a 4-2 on 150 square meters of building area.
Or taking the dining room and turning it into a bedroom, which
because then you're out of the kitchen into the wall, So, because I've seen that happen. I've seen people change. You would have seen it too, right? And they think
they'll get a tenant in there, but I'm like, someone coming through goes, "This is not a true 4-bedder,"
Yeah, exactly. But I've seen. So we just bought a reno flip site for a client, and by the way, they're very hard to find. Probably the hardest asset to find because you need that floor area. So we found one that was a 4-1, but the building envelope was 230 square meters. Wow. Right? It's 25 square. And there was enough we could do enough adjustments for our property to turn it into a 4.2. We bought it for 8.30. They're going to spend about 110K. And in that suburb, 4.2s with a carport sells for about 1.15.
Nice.
Right? 1.15 to 1.2. Now, if they decide to sell it, they make some money. But I actually think, like, I've seen the best use cases is where clients buy in a market that's growing. They create the value, whether it's at the end or at the start, but they ride that growth wave, because when a market's at the bottom and when it goes to the top, right, like from bottom to peak, if you look at Brisbane, you'll double your money just on land value increase. So imagine the value you create just by adding that. If you're doubling, it'll be even more. So yeah.
When does an Airbnb strategy make sense, do you think?
Yeah, that's a great question. When it's lifestyle.
Okay.
Yeah, in my opinion. So, look, we've had a few clients where we've helped them actually secure these sites, but generally speaking, the objective is I just want a lifestyle property for my family to go there, once a month, once every 2 months, but I don't want to have it sitting there vacant. And the Airbnb strategy just adds value because it gives you an income to offset the payments that you're paying, right? So it works really well when it's a lifestyle decision. When it's an investment decision, I know there's a lot of like YouTubers that talk about arbitrage and hiring units, making money. I don't know. Look, I don't know much about that space, but I think the number one goal for any investor needs to be capital growth, right? Because creating equity is what gives you the lifestyle.
Yeah. I think this notion of chasing, I'm very conscious to say there are multiple ways to invest. So, hey, this isn't the only model. But what I want to challenge people listening, if they think they need cash flow, what I generally would try and suggest is you become your cash flow asset, i.e., earn as much as you possibly can in your role. Get upskilled, get a qualification, work your butt off. That's the cash flow increase. Because if you're trying to get a property to deliver you cash flow, that's a slow burn. Or you're buying an asset that's yielding good amount, but are you able to leverage against it? And what we mean by that is generally once people get the bug bitten, they then want to buy again and go again. Now, if we can't strip the equity, you're a frustrated investor. You've got the abilities and the means maybe to go and buy another property, but you've got no equity or you've got no deposit for the next investment property as well, which is why we say, hey, buy a growth asset, keep building your portfolio. And then at that point, once you then can choose to sell down an asset, you can clear some debt and then you will generally get that cash flow. But I just want to challenge people that think that they need the cash flow as opposed to, hey, if you're in an acquisition phase, maybe we should be looking at this as through the lens of a growth asset. Which brings me to my question to you. If I'm a first-time investor starting out on my journey, what advice would you give to someone to get them in the market? And the reason why I ask this is because I call that first one that cornerstone property. You get this right, mate, you're off to the races. You're on to the next one. I've done, so many investors that have gone from 0 to 2 or 3 in a year because they've just bought a growth asset, revalued, worked their butts off, good incomes, and we're going again as well. So I think there's a lot to be said about that first one. And generally a lot of first-time buyers maybe balk or flinch a little bit at paying a BA fee. Now, naturally, you have a horse in this race being a BA yourself, but take you out of the equation. It's like me saying everyone should use a broker. Naturally, I'd say that because I'm biased, but put the bias aside and go, hey, this is an expense well worth it because X, finish the sentence. But I want to hear from you, mate, going, the first one, why is it so important? How do you get the team right? How do you get yourself in the right mindset to then pull the trigger on your first purchase?
I think that's a great question. I think just being very clear. It's like going into it with an open mind and being completely agnostic to location and not using sentiment, like personal sentiment, to buy your first investment. I think if you start the journey off like that, I think there's lots of opportunities that you can create just by being able to get into different assets. Like if you're buying in the same suburb you live in, you're probably going to be the best BA out there because you know all the good spots and bad spots. But it's not necessarily going to mean that it's the best investment strategy for you. And I think this is where it unlocks the buyer's agent. The buyer's agent, any buyer's agent out there should be able to really understand your strategy. The first property needs to be growth. You need to be buying in a market that's going through a growth cycle. I wouldn't necessarily look at historical trends to give you the confidence that it's going to be the best location to invest in. Because sometimes some markets could be nearing their peak. Sometimes, so I'd probably look at maybe the fundamentals, but look at, like, I would be talking to the buyer's agent and maybe just qualifying them around how do they assess growth, what are some of the exit strategies do they have, with the markets that they're suggesting. I think be really clear on what cash flow position you need that property to be in, so that you can hold on to this asset to reap the maximum reward out of it as well. Because just because you can get $1 million loan doesn't mean you can afford $1 million loan. So just be really clear on that. So was that the first question? Did I answer the first one?
Yeah. And then it's, again, from your experience, what you've seen really, really good investors do when they're starting out is like, how do they get out of their own head, and how do they get out of the way?
Yeah, well, it's creating that mindset. So mindset is probably, I talk to my clients about this a lot. You got to be open to engaging professionals. Like, I think you said this before. If you're good at, if you're a niche, if your source of income and cash flow is coming from a certain job or a certain skill set, exhaust that, right? Do the best you can in that space, but hire professionals around you that are subject matter experts in their field, right? Having like a good accountant, because accountant's going to help you structure, right? They're going to give you the best advice. They know your financials. One day you're going to have to sell down that asset, so or you're going to have to consolidate your debt. What is the best structure? Oh, I hear a lot of stories sometimes where people say, "I wish I spoke to my accountant and bought this under XYZ." Okay. Number two, the right broker. Like, just because there's a very low entry point, in my opinion, for brokers and buyers agents.
Well said.
So you need to qualify the people you're working with. It's not about how many properties do they have, but it's more so about what strategy do they have.
Man, I know you got a race, so I appreciate your time. Like we said, any guest that comes on here isn't farming or fishing for business, but I mean, what we'll do is we'll include the details. As people want to pick up the conversation and find out more about you, we'll include details to your Mecca Property Group as well. Mate, but I just want to say thank you very much for your time. Thanks for your energy and your effort, mate. I genuinely appreciate you sharing with us, and keep up the good work.
Thank you for having me on. It's awesome, man. Also, it'll be awesome to meet you in person one day.
Will do, mate. Thanks very much. Thanks, guys. That's a wrap for another episode of the Australian Property Investment Podcast. We'll talk to you next time. Thanks very much.